Welcome to another pristine 60-second lesson, Why Candlesticks? This 60-second lesson is part of a library of educational material intended for beginning traders, but may also be very beneficial to intermediate traders because so much information out there about trading is inaccurate. There are many ways to view price data. The most common ones are line charts, bar charts, and candlestick charts. Line charts only offer one piece of data per period, which is typically the closing price. Bar charts offer 3 to 4 pieces of information per period, but can be confusing to read. A candlestick chart is comprised of individual candles which each represent one period of time based on the time frame you are viewing. For example, a 5-minute chart would have every candlestick representing a 5-minute period of time. There are 4 pieces of information contained in every candlestick. There is an opening price, the low for the time period, the closing price, and the high for the time period. If the closing price is above the opening price, it is colored green, and we consider the candle to be won by the bulls. Likewise, if the opening price is above the closing price, it is colored red, and we have considered the period of time to be won by the bears. Those highs and lows can be called tails or shadows or wicks, whichever you prefer. Pristine, we typically call them tails, topping tails, bottoming tails. Candlesticks are superior because they show the important relationship between what happened since the open as well as the prior day's close. They convey the information in a way that is visually efficient. And when candlestick patterns are combined with proper technical analysis using the pristine method, it is all that is needed to help increase trading performance by reading the price action of any instrument. You just saw how those 4 pieces of information come together to form a candlestick. They actually can combine into an infinite number of ways to form various shaped candlesticks. However, they generally fall into one of several distinct categories. If the closing price is higher than the opening price, the bar is colored green, and we say that the bulls have won that period of time. The reverse is true, and then the bears win. Just 2 candlesticks can sometimes create a strategy. Several candlesticks can come together to form various forms of pivots, which then can lead to trends. The study of pivots and trends is critical to the understanding of price action. Candles are the first building block of technical analysis. When learned properly, the knowledge is built upon. 2 candles can sometimes make patterns, several candles can form pivots, and pivots can form trends. The quality of each building block determines the overall quality of the pattern. This all comes together to form the pristine method. If you want to learn more, contact your counselor for a free learning module that shows how Pristine teaches at a 3rd level of learning. Now you know the basics of candlesticks, Pristine style. Pristine teaches their students the optimal ways to use candlesticks to help increase trading performance from price action. If you like this 60-second lesson, be sure to view our other 60-second lessons and register for our next online trading essentials class. 4.5 hours of lessons free to viewers of these 60-second lessons if you sign up now. You can also sign up for our free power trading workshops after the market at 4:15 p.m. It's easy to get this information. Simply visit our website at pristine.com. Get the correct information from the leader in the industry. Pristine Trading. Trusted by all and teaching the marketplace since 1994. Proud to be winner of the Trader Planet publicly voted Best Trading Course, Best Trading Room, and Best Letter. Greg Capra, founder and CEO, Record Trading Challenge winner. And Pristine's preferred broker offers Pristine clients among the lowest commission rates in the industry and can pay for much of your training with commission points redeemable at Pristine.
The term technical analysis might sound a little, well, technical, but it's actually pretty simple. Essentially, it's a strategy an investor uses to examine an investment's chart in order to forecast its future performance. Many investors use technical analysis to identify when to enter or exit a stock position. When performing technical analysis, investors can use a variety of techniques and tools to analyze a chart. In this video, we'll focus on a few technical analysis basics, including trend, support and resistance, price patterns, and technical indicators. Let's start with the first technique, trend. Trend is the general direction a stock's price is moving. There are 3 kinds of trends. Up, which is a series of higher highs and higher lows. Down, which is a series of lower highs and lower lows, and sideways, which has roughly equal highs and lows. Investors determine a stock's trend by identifying the direction of its highs and lows. Trend is important because many investors believe that a stock will generally continue in the same direction it's been going. These investors would anticipate a stock with a strong uptrend to continue to rise, while one with a strong downtrend will continue to fall. Many investors draw lines to help identify the trend. Investors can also draw lines to connect highs and lows. These lines are known as support and resistance levels, the next technique we'll discuss. Support and resistance are price levels that the stock has had trouble breaking through. If a stock breaks through support or resistance, it could be a signal to enter or exit. For example, suppose a stock breaks through resistance, which is a level it repeatedly pulled back from in the past. Because it broke through resistance, many investors believe that there's a good chance that the stock will continue to rise. So broken resistance may be a good time to enter. On the other hand, if the stock fell past a support area, it may continue to fall. This is usually considered a good time to exit. After connecting support and resistance levels, a stock's price movement may resemble a certain shape. These shapes are called price patterns and are another technical analysis technique. Price patterns can build on support and resistance, allowing investors to predict more specific movements and point out even more precise entry and exit signals. There are many different price patterns. Some examples include simple shapes like triangles or flags, and more complex patterns like head and shoulders or triple tops. Let's look at an example. This is called an ascending triangle, and it forms when a stock's highs are hitting resistance while its lows are steadily rising. Some investors might interpret the narrowing between the highs and lows as a signal that the stock's about to break through resistance. If it does, the stock's price is expected to rise in value right after the breakout. But not all investors exclusively use support and resistance and price patterns. Drawing lines and finding shapes can be subjective. Because of this, many investors also use technical indicators. Technical indicators are graphical representations of chart data. Each indicator displays chart data, like price and volume, in a unique way, giving investors another perspective of the stock's performance. Because technical indicators are created using formulas and data, they give investors a more objective way to examine a stock's performance. One of the most common technical indicators is a moving average line. This indicator averages the stock's price over a period of time and plots it as a line, which can help determine the overall trend. Moving averages can be calculated for any period of time, but one of the most common is 50 days. So what does a moving average tell you about an investment? Imagine a stock's price crosses above its 50-day moving average. This indicates that the stock is outperforming its recent history. This could be an entry signal. Similarly, if the stock begins to fall and dips below its moving average, it could be an exit signal. Moving average lines are only one of many technical indicators you may use. Other common indicators include price envelopes, Bollinger Bands, stochastic oscillators, and the relative strength index. At this point, we've covered some basics of technical analysis. One thing to keep in mind is that technical analysis can help you identify entry and exit signals, but it offers no guarantee of success. After all, there's no way to predict the future. However, many investors use technical analysis to help them put probability on their side. We've only covered the tip of the technical analysis iceberg. Learning how to use the techniques and tools we've discussed, as well as the many others out there, can advance your technical analysis skills.